there's basically three key reasons why we don't think this is going to be a repeat of sort of 1990 or 2008. The first one is basically that the house price to earnings ratio now is at a very similar level to 2007, 2008. But we're expecting mortgage rates to peak at 3.6% rather than 6%. And what that means is that mortgage affordability, or the share of income needed to service a typical first-time buyer mortgage, for instance, is not going to get anywhere near as stretched as then. So, in terms of the extent of overvaluation, it is not as bad as 2007, 8, or 1990. The second reason is that lending is healthier in terms of a loan-to-value perspective. So we've had a lot less lending at 90 and 95% LTVs, and even higher since in recent years compared to in the run-up to the financial crisis. And you've got to pair that with the fact we've had extremely strong house price growth over the last couple of years. Of course, prices up by about 20% since the end of 2019. And what that means is that most homeowners have a significant chunk of equity in their house, which reduces the risk of negative equity. Which, of course, so that should avoid sort of problems with incentive to repay the mortgage from that point of view. And then finally, one of the main reasons we have an above consensus interest rate forecast is that the labour market is extremely strong. And that should help in two ways. Firstly, because unemployment is low, we're not expecting a big rise in forced sales, so limited supply will help support prices. And secondly, it also means we're likely to get quite strong wage growth. In fact, we're already seeing wage growth being strong. And what that means is that we need less of a drop in house prices in nominal terms in order for them to get to a sustainable level relative to wages. So sort of rising wages help bring that house price to earnings ratio, and indeed the cost of servicing a mortgage, back down to a sustainable level without a bigger fall in house prices.